What's up, everyone? It's Connie with MoneyVest. So it is time to fly, I guess, because markets are seeing a very nice technical rebound as this continues. And we're seeing a little bit, of course, the M7 stocks, Magnificent 7, growth stocks. It's a very, very risk-on environment in the markets on the back of yields dropping lower. And, we've talked about how the markets have significantly been under a lot of pressure since July because the yields have been going higher. I mean, the yields are up, 30-40% since July. And since, of course, December of 2020, yields are up over 500% to trading almost as much as 5% for the 10-year treasuries, right? So markets have had a very, very hard time in finding any type of solid ground to rally. Of course, 2023 has been very strong on the back of big tech companies, but then since July, we started to roll right back down as the yields continued to push higher, and now we're starting to see that momentum come back down for treasuries, and the markets are seeing a lot of risk on environment. So I'm going to break everything down. Of course, we had the Fed meeting yesterday, and Jerome Powell, basically saying that, or basically talking tough, right? That was the whole takeaway from the Fed meeting, is that they wanted to make sure the markets understand that they're not done yet, and if push comes to shove, they are willing to go the length to increasing rates further if there is any signs of inflation staying elevated or accelerating back higher, basically not coming down to the Fed's target. So all that will be covered in this video. Make sure that you drop a like and, of course, subscribe to the channel. If you are just joining us for the first time, I would really appreciate it. And link to our Discord and Patreon is going to be down below if you're interested in joining and, of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members only private videos. And I'm also going to start sharing very, very high quality directional swing trading opportunities for the market. So this right here is something that I mentioned in our community. I basically mentioned that in our continued analysis on the NASDAQ with the volatility. Moving forward, I will point out the best swing trading setups on the S&P and the NASDAQ as combined with the VIX, right? So they will require a lot of patience, proper execution, and risk management. These three ingredients are very, very important because the number one, patience, because of these setups being so high quality, they will not show up every single week, every single day, okay? So these are not setups that we'll find, every day or every week or even every month. These setups may appear once or twice, maybe if you're lucky, 3 times a year. Yes, that's right. 2 to 3 times a year because of such high quality setups. The probability of success is going to be higher. I back-tested this analysis, and during different time frames, we were looking at anything over 70 to 80% win rates for this strategy, for looking at NASDAQ specifically with respect to volatility, because there's an inverse correlation. And we'll identify the overall trend. We'll look at the critical areas of support and resistance, volatility levels, and that's where we have the VIX cheat sheet. The percentage of stocks trading above or below their moving averages, that's telling us the market breadth. And M7 is going to obviously be the driver for the markets, because M7 index, which I've created on TradingView, is going to also help us better understand market direction and, of course, risk and reward as well. Tradable stocks, of course, with this strategy is going to be TQQs, SPY, VUG, QQQs, all those different things. And like I said, the back testing has been done. It's still going on right now because there's different time frames you have to run the analysis on. But so far, the results are very good, and I will be pointing out these trade setups in our Discord. So again, if you want to get access to these ideas, links are going to be down below if you're interested in joining. We'd love to have you on board. So this is what the market looks like. Very, very strong momentum for Tesla here. 5%, Nvidia, Apple, all of them pushing higher so far in the day. And this is what the December meeting looks like. We've got another SEP, Summary of Economic Projections, coming out in December. So 82% probability that the Federal Reserve is now going to hold rates steady at where they are. Again, that's unchanged from what we have seen before. And December is obviously their last meeting for the year. And they've penciled in one more potential rate hike in their SEP. And between now and the next Fed meeting, we've got 2 inflation reports and 2 unemployment reports coming out. 1 unemployment report this Friday. So tomorrow, I will be live to cover that. And inflation number is going to be, I think, next week. And then, of course, the first week of December, we've got another unemployment report and inflation numbers. So we'll have plenty of data to better assess what the Federal Reserve's next move is going to be. But the market's very clear and understanding that we are done. There are not not going to be any more rate hikes anymore. And as a result, we're seeing the yields roll over, and the market's expecting for us to stay at these levels until summer of next year, and then seeing rate cuts in June of 2024. So those are the expectations. So Chris Zaccarelli says, and I quote, "We expect Powell to talk tough and do his best to keep markets from taking the 2 successive skips in interest rate hikes as a green light for risk assets." And we were surprised at how detailed he has been in his language, that the Federal Reserve is still worried about inflation and wouldn't hesitate to raise rates again in the near future. But the market is not buying it. The market is simply not buying Jerome Powell's bluff. Now, is that a bluff or is that for real? We'll find out in the next 41 days, after 41 days when the next Fed meeting takes place. But it was very clear that Jerome Powell wanted to talk down on any type of talks related to rate cuts or any type of talks related to rate pauses. He wanted to make sure that he understands that it's important for markets to believe him in his expectations of rate hikes that are still potentially on the horizon. But of course, the market's not buying it right now. Now, weekly jobless claims on Thursday ticked higher to 217,000. Now, this number is still not concerning. Anything over 300,000 is really when it starts to become very interesting from an unemployment standpoint. And tomorrow is when we've got the unemployment payroll numbers. So jobless claims already came out earlier today. JOLTS numbers came out earlier this week, so a little bit over 9.3 million. But tomorrow, we've got the non-farm payrolls, 170,000 new jobs expected at 3.8% unemployment, which once again continues to suggest that this is going to be a very, very, very resilient and strong economy. Now, in the past, I want to highlight that the soft landing hopes have been almost identical to what we are seeing right now. I'm not saying that this time it's not possible. Of course it is, because we are dealing with completely different circumstances, different variables are at play. So given how high the interest rates are, the soft landing is a possibility. And what soft landing really is interest rates as high as they are, not impacting the economy, so the economy kind of avoiding a recession. Economic growth continues to be strong. Unemployment continues to be strong, which both of those things are in fact true right now. But at the same time, inflation also coming down, despite how high interest rates are. It's not really affecting the economy. So that's really what a soft landing is. And every single time you'll notice back in 2000, back in 2007, 2008, and now in 2023, the number of news articles mentioning soft landing has substantially increased, right? So we are seeing a significant amount of spike here in the narrative around soft landing. And that's, again, the soft landing expectations versus the hard landing realities, right? In other words, the hopes of soft landing did not materialize. In fact, we got a very, very significant hard landing in those 2 time periods where we eventually dealt with significant recessions. Now, not saying that this time also it's going to be the same thing, but if history is of any guide, we got to be, very, very careful. We got to keep our eyes and ears open to economic data, which is, again, starting to show some signs of weakness, but it still continues to be very resilient, right? The economic overall landscape in the U.S. At the moment. Now, if you come over to yields, now this is really what's driving the markets higher, right? So you've got, again, like I showed you guys, a significant move to the upside. We got the M7 index up over 1.3%, with the nasdaq here up over 1%, S&P's up over 1%, the Dow Jones also rallying a little bit over 0.9%, so a little bit over close to 300 points. So we have nothing but a lot of momentum on the day. And this is what risk on feels like, because you do have a lot of other companies. So for example, Lemonade up 37%. We got Roku up 25%. Shopify is up 22%. Palantir reported earnings. I'll be doing a video on Palantir later today. 21% gain. InMode up 11%. We've got Enphase, I think, was also pushing higher finally on the day. So up over 2.6, just a little bit over $78. And PayPal is up over 4% as well. So lots of momentum coming in for these riskier stocks, I would consider. I mean, maybe not Starbucks, but there's a lot of them, like Fubo, for example, Trulieve, you got Shopify, Roku, Lemonade. A lot of these unprofitable companies are definitely pushing higher on the day very, very nicely on the back of yields dropping. And of course, M7's also grabbing a lot of liquidity on the day because yields are rolling over. So if you come over to the overall chart, this is the 3rd time I'm witnessing some type of a negative divergence, right? So if I go over to US 10-year yields here, what you'll notice is that I've basically marked 3 instances where the treasury yields were making negative divergences. I was actually going to do a video about this over the weekend. I'm definitely late because I had this on my chart. Believe it or not, I had this, but it just got way too busy very, very quickly with the Fed meeting, with the earnings, that I completely forgot that I wanted to do a video on this. And this right here were the 3 instances that I had on my chart where you've got a horizontal RSI with a higher high on the yield. This right here was the RSI overbought at over 70 and a lower high forming with the higher high on the yields. And this is the 3rd time we witnessed that I wanted to highlight in that video. And this is a negative divergence, right? Meaning we are seeing a higher high on the yields and a lower high on the RSI. That's weakness in breadth, which does suggest some potential downside. And last 2 times we saw that, yields dropped 26% here, yields dropped 22% over here. And right now we're only down about 7 to 8%. So if you do see a very similar 20-25%, we could be sub 4 very, very soon. One more thing I want to point out is the 50 simple moving average. So if we take a look at the 50 EMA, it's going to update this one. We're going to make that appear on the chart. Very, very nice, consistent uptrend for the yields, and the 50 EMA continues to act as some type of validation here. Again, the technicals don't really apply. Support resistance doesn't really apply on the yields because it's mostly driven by the price of the bond, and that's where the demand supply is coming from. But if you do end up breaking down below this 50 EMA at sub 4.6%, I think there is a possibility that we do shift that trend very, very nicely. And if you do break down below this previous yield of about 4.5%, 4.5%, then it's possible that we do see some acceleration to the downside for the treasuries, and that's going to once again increase this risk-on environment in the market and create a lot of opportunities for growth stocks at the moment as well. So that's where we are. Everybody's just really waiting on the yields, and they are dropping on the back of the Federal Reserve's meeting yesterday, and in hopes of the Federal Reserve being done finally with the rate hikes. But let me know in the comment section down below. What do you think? Is the Federal Reserve really done, or is the market really just in this hopium pushing higher that they are indeed done? So let us know in the comment section down below. I do still have a feeling that maybe 25 basis points in the pipeline. Could be in December, could be early next year. Depends very much on, of course, inflation numbers. But let me know in the comment section down below. What do you think? Do you believe the Federal Reserve is done, or is the markets not really fully understanding of the idea the Federal Reserve could indeed raise rates one more time and they're not bluffing? So let me know in the comment section down below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.